One of the hardest things about investing is knowing when to sell. Knowing when to unload a mutual fund is especially tricky because yesterday's champ can turn into tomorrow's chump with little warning. So here are some guidelines about when to lighten up. For starters, some reasons for selling may have nothing to do with what's going on at the fund itself. In fact, you may want to sell a fund, or at least some of your position in it, because it's done so well that it has thrown your investment mix out of whack. To bring your allocation back to the desired percentages, you rebalance your portfolio. And to do that, you sell some of a fund that has been performing well. Or your goals may have changed. For example, that aggressive fund you bought 15 years ago, when you were 50, may not be right for you today as you get ready to retire. So it's wise to sell at least some of your position in that fund. You always want to be on the lookout for asset bloat. That refers to funds that have grown so large and cumbersome that they become too difficult to manage. Departure of a key manager also raises warning flags. So does a change in a fund's strategy. If you buy a fund expecting it to focus on, say, small U.S. companies, and find that the fund has morphed into something that mainly owns large foreign companies, you may not want to stick around. Selling funds for performance reasons is the trickiest of all. Conventional wisdom says to dump a fund if it trails its benchmark or its peers over a stretch of 3 or 4 years. But every actively managed fund goes through dry spells, so we don't think you should follow this rule blindly. What you should do is see how a fund has performed in both up and down markets. In the case of stock funds, that would mean going back to at least 2008, the year the U.S. market tumbled 37%. If you find a fund lags in both up markets and down markets, that may be a signal to move on.